You know, it's funny, after my last video, don't waste your time buying apartments, I got a lot of comments. Stuff like, retail is risky, flex spaces sit empty, industrial tenants can hurt my feelings too. And look, I get it. If you've spent any time around real estate investing, you've probably been told that apartments are the safest, surest path for you to get financial freedom. But what if that isn't true anymore? At least not right now. What if chasing multifamily right now could actually be the thing that is holding you back? Because here's the reality. You're not walking into a gold mine when you buy apartments today. You're diving into the reddest of red oceans. It's overcrowded, overpriced, and oversold. And the biggest myth of all, the one almost every new investor falls for, more doors equals more freedom. If you just buy enough duplexes, triplexes, or apartment units, then you'll finally have that passive income lifestyle. The one where you wake up whenever you want, you travel the world with your family, and you live stress-free. Yeah, except it rarely plays out that way. I've seen it firsthand in my own portfolio and with the hundreds of investors that I've worked with. You don't build real freedom by stacking doors. You build real freedom by owning the right assets. The ones that actually pay you without eating all of your time, draining you of all your energy, and taking away your peace of mind. And today, I'm going to show you exactly what that looks like. We're going to break down what I'm buying instead of apartments, the exact numbers, and why this path, while it's way less crowded, has completely outperformed multifamily for me, for my students, and for other smart investors out there who are just tired of fighting over scraps. And if you stay to the end, I'm also going to introduce you to a few folks like Ryan, Marcus, and Ron, who have pivoted away from apartments completely and transformed their investment portfolios and their lives. So let's dive in. All right, so let's talk about one of the real deals that I am working on right now, a 105-unit self-storage facility in Madison, Tennessee. We raised capital from our investors and bought it for $1.7 million earlier this year, and here's why this deal stood out. First off, we bought it at a price where the cash flow makes sense from day one. Not based on some crazy pro forma, like a lot of apartments, not based on praying for rent growth, like a lot of apartments, actual cash in the bank. Plus, we had some vacancy that we could go and fill on top of all of that. Now, when we took it over, occupancy was around 58%. We had some rough spots to clean up, for sure. 7 delinquent units, deferred maintenance, no real systems in place for rent collection. But here's the thing, this wasn't that complicated. It wasn't about adding granite countertops or hoping for $300 rent bumps like you'd have to do in the apartment world. It was basic operational fixes. We got the rent rolls transitioned over. We started automating payments. So simple. We began the legal process to auction off delinquent units. And within 60 days, we were already on track to push occupancy over 80% without lifting a hammer or spending a fortune. Pretty simple, pretty straightforward, very profitable. And the best part of that is that this facility isn't just throwing off solid cash flow, it's giving us real options for the future. Because once we stabilize it at that higher occupancy, we've got multiple exit strategies. We could refinance and pull some cash out, we could sell it for a higher cap rate, or we could just keep it and cash flow it with very little management needed on a day-to-day basis. Compare that to buying a Class C apartment complex right now, where you're probably paying close to a 5% cap rate, you're managing 100, sometimes very angry tenants, fielding maintenance calls, and praying that insurance rates just don't go up again. That's not freedom, at least not to me. That is another job with more risk baked in. With this self-storage facility that I'm doing, I'm building real wealth quietly without having to fight in a red ocean. And the crazy part is, this isn't just possible with self-storage. You don't have to box yourself into a single asset class anymore. The opportunities right now stretch way beyond that, across asset classes that most investors aren't even paying attention to. Take Marcus, for example. Marcus built a brand new flex space development outside of Birmingham, Alabama. But he didn't just throw up a metal building and call it a day. He went high-end, brick facade, premium lighting, luxury vinyl plank floors, even cedar overhangs. I mean, come on, look at that. All the details that most developers cheap out on. And because of that, every single bay was leased out in under 2 months. No negotiation on rents, no tenant turnover games. He didn't have to race to the bottom because he built a better product. And now he's pulling top of market rents with virtually no vacancy risk. While everybody else is still wondering why their generic flex buildings are probably sitting empty, Marcus created his own blue ocean. Then there's Ron. Ron's focused on industrial outdoor storage, IOS. He buys industrially zoned land, puts up a fence, installs some lighting, and leases it to trucking companies by the month. No fancy build-outs, no complicated construction. At one site, Ron turned a run-down office building and a dirt lot into a cash flow machine, stacking trucks on the yard, leasing maintenance bays, even charging for amenities like tire removal. And because he bought in a fast-growing industrial corridor, that land could easily be worth 2 to 3 times more just within the next few years. Strong monthly cash flow now, massive upside later. It's one of the most overlooked, flexible strategies in commercial real estate today. And then there's Ryan. Ryan was deep in the multifamily game. Dozens of units, constant management headaches, constant turnover. On paper, he looked successful, and he was. But behind the scenes, he was chained to the business until he shifted into triple net investing. Now, instead of babysitting tenants, Ryan owns assets like a corporate AT&T building in Chattanooga where the tenant pays the taxes, the insurance, and the maintenance on the property. All he does is collect checks and occasionally renew a lease. Not too bad. Today, Ryan's portfolio is worth tens of millions of dollars, and his investments run quietly in the background while he spends more time traveling with his family and living life on his own terms. Ryan's story hits close to home for a lot of investors, because for a long time, Ryan did exactly what he was supposed to do. He built a portfolio of single-family homes. Then he scaled into multifamily. More doors, more tenants, more management, more headache, and at first, it looked like it was working. The unit count was growing, the portfolio value was growing, the revenue was growing, but so were the headaches. He was stuck putting out fires and managing evictions, dealing with maintenance emergencies at all hours, chasing rents from tenants who were one bad month away from defaulting. And the bigger his portfolio got, the more it felt like his portfolio owned him, not the other way around. That's when he realized that something had to change. He started studying commercial real estate differently, maybe because we had a coffee back in 2018 and I told him that he should be investing in triple net properties instead. So he stopped chasing doors and started chasing better tenants and better deals. Deals where the tenants were businesses, not individuals. Deals where the income was secured by long-term leases, not month-to-month or annual uncertainties. Deals where the buildings could basically run themselves. And that's when he made the pivot into triple net investing. Now let's hear it from Ryan himself.
Hey guys, my name is Ryan Stackhouse. I currently live in South Padre Island, Texas. Tyler and I met in Nashville, Tennessee, where I lived for 10 years. I went from buying single family homes to apartments and then sold all of our apartments. And now we own triple net, absolute net lease, mostly industrial, but we own some medical treatment facilities, doctor's offices, things like that.
At what point did you realize that multifamily wasn't going to give you the freedom that you wanted?
I'd say 3 or 4 years in to owning, we were up to like 450 units or so, and I just saw no consistency with it. We started with multifamily with the intent of getting free of the rat race. I had enough equity in these single family residences to trade into apartments or trade into another asset class that would give us, some level of financial freedom. And what I started learning was it was just a glorified single family formula. You'd have years where, yeah, sure, profitability was good. And then the next year, got to replace a roof or got to replace many HVAC units or have lots of vacancy. And that year basically wiped out all the NOI from the year before. So we wanted something more stable.
Was there a specific moment or breaking point when you knew you had to make that shift?
I think everybody that's a successful investor will tell you it's pain that makes you change. I got tired of writing checks, for repairs or having vacancies or all the things that come along with apartments in our triple net and absolute net lease space. I mean, they'll send me the invoice, I pay the invoice, and I'm done. It's literally like a 5-minute thing. I'm not dealing with looking at spreadsheets every month to see what did it cost me for the roll-off dumpster this month. It's just vastly different.
How did you discover triple net investing as an alternative to multifamily?
You were I was talking about, Ryan, you need to start doing triple net, absolute net. You need to do different kinds of commercial. And I was always like, oh, yeah, I hear you, whatever. And I was dead set on apartments just because that's what I had kind of focused my energy and time and money towards. But I started seeing the light after a few years doing it myself. I'm the type of person, I got to do stuff the hard way. I got to learn things on my own before I'm totally convinced. And I learned pretty quickly that you were right. The triple net and absolute net lease space, especially industrial, I really love industrial these days, the tenant improvement. So when you own a building and it goes vacant and you get a new tenant that comes in, usually they'll request some sort of tenant improvement budget. I'm finding in the industrial space that's minimal to nothing. We own an office space down in Mobile, Alabama, and we're finding on that one, even we found a call center, and since it's already set up as an office, we don't need to do any TI, and that tends to be the case on our industrial properties. So I love that. With medical buildings, that is not the case. A lot of times you're paying 250, 300 a square foot to do a TI improvement for a surgery center or a doctor's office just to get it all set up for them. And that gets very costly.
What changed in your day-to-day life after switching to triple net investments?
Well, I retired. I'm doing more important work, which is raising my kids. My kids are little, and it's more important to me to spend quality time with them. And I get to surf almost every day. I get to go scuba diving. I ride my bike. That's the stuff that I'm never going to regret later on when I'm in my 80s, 90s, looking back on my life saying, I wish I would have.
What advice would you give to somebody watching this video who's feeling stuck in apartments right now?
I would say open up your mind, talk to other people that are doing other asset classes like triple net, absolute net, especially in the industrial space. It's a small niche, and I really love that too because there's way less competition than in the apartment world when you're going after a deal. I would say find people that are doing and living the way you want to live and learn from those people because I'm investment agnostic. You show me a better investment, I'm all ears.
What Ryan figured out, and what most investors never do, is that this game isn't about buying the most properties. Who cares about how many doors you have? You're just one smart deal away. One overlooked property in a submarket that no one's paying attention to that ends up changing everything. That's the kind of work that we're doing inside the CRA Accelerator. It's not a theory-heavy course. It's not a bunch of fluff or recycled tactics from 2012. It's a step-by-step blueprint paired with real-time coaching from me and feedback from other people who are actually out there doing deals right now. We help you build consistent deal flow, underwrite opportunities the right way, and get into the kind of assets that actually give you back your time, your freedom, and your peace of mind. Just like Marcus, just like Ron, just like Ryan. So if you're ready to stop chasing what's familiar and start buying what actually works, this is your invitation. Click the link below to schedule a call with me to learn more, and let's go find you your first or next great deal. Because you're not 100 doors away. You're just one deal away from changing your life.